Hi there, welcome to the kinds of orders video. We're going to look at the different kinds of entry orders, we're going to look at the different kinds of exit orders, and at the end of it all, we're going to show a complete group of orders in a trade. The kinds of orders. There are several ways to get into and out of the market. Entry orders and exit orders. There are kinds of entry orders. There are market orders. These orders are carried out right away. These will get you into the market right now. And then there are pending orders. These orders are set in advance before price reaches a certain level. So you'll be placing an order away from where the current market is. And then once price reaches that level, then you'll be triggered into a trade. There are kinds of exit orders. We have the close the trade now order. There are stop loss orders. These are always placed behind the current price of the market. And then there are take profit orders. And these are always in front of the current price. Now I'll explain these a little bit more. The kinds of entry orders. Again, there's market orders. You can buy and sell with a market order. These will get you in right away. Then there are pending orders. There are stop orders and limit orders. Now, these are the different kinds of pending orders. And with each of these stop and limit orders, you can buy and sell. Again, the market order gets you into a trade immediately, instantly at the current market price. If you want to get into a trade right now, you'll use a market order. There's a buy market order and a sell market order. You can get into a buy trade or a sell trade using a market order. On your trading platform, entering a market order is usually as simple as clicking buy or sell. You click buy, sell, then you click the confirmation and you'll be in the trade right then and there. A pending order is simply an order that you place on your platform that isn't triggered right away like a market order is. A stop order is a kind of a market order. A stop order is an order that you place ahead of the current market price. So we'll take a look at a buy stop order. This is an order to buy. You'll use a buy stop order when the market hasn't yet reached the price you want to get into the trade at. Price will start off being under the buy stop order. This is what makes it a buy stop order. Price will have to be under the order, under where you want to get in. Price will have to climb up to trigger your order. So price will rise, trigger your order, and then in order for you to make a profit, we'll have to keep rising because you'll be in a buy order, a buy trade. So a buy stop order, price starts underneath, and that's what the solid blue arrow is underneath. And then the black dashed line is the buy stop order, which is placed over the current market price. So it's placed over the price right now in the market. So over time, after the order is placed, market climbs up higher, higher, touches that level, touches that order, gets you into a buy trade, and then will have to continue moving up in order for you to make money on the trade. A sell stop order is everything in reverse. It's a sell version of the buy stop order. A sell stop order is used when you want to enter a sell trade when the entry is below the current market value. Price will have to drop from where it is to your entry level. It'll have to move down to trigger you into a trade. Once you are entered into the trade, you will want the market to continue dropping for you to make a profit. Price will start off being above the sell stop order and then will have to drop down to meet your entry. So again, here's the chart. The solid blue is the current market. The arrowhead on that solid blue is where price is right now. The dashed line is going to be below the current market. Price will then have to meet it because that's where the sell stop order is placed. Price will have to drop further, finally trigger you into a sell trade. And then in order for you to make money, price will have to keep moving down because you are in a sell trade. Now there are limit orders. A limit order is a pending order. The order you place when you want the market to hit a certain price, trigger you into the trade, and then the market will have to change direction in order for you to make a profit. This kind of order is frequently used in a range-bound market. It's a market that is bouncing up and down within a defined high and low range. A buy limit order is what you'll use to get into a buy trade. The market has to initially be moving downwards, hit your entry price that is placed below the market, and then in order to make a profit, price must move back up because you are in a buy trade. You'll enter a buy limit from above. So the price will be above the buy limit order. The buy limit order is placed underneath the price. Price comes down, touches the order, gets you into the trade, and then must move up because you're in a buy trade in order for you to make a profit. A sell limit order, again, the opposite of a buy limit order, will have you taking a sell trade, but the market must approach the entry level from below. So you see the chart, the solid blue is the current market, has to climb up to tag the sell limit order. Once it tags the order, gets you into a trade, into a sell trade, the market must then change direction and then move down because you're in a sell trade in order for you to make a profit. Exit orders. Now, getting out of a trade is just as important as it is getting into one. First, we'll look at the close trade order. Like a market order, for instantly getting you into a position, you can simply close the trade to instantly get you out of the position. Closing a trade is something that you have to be present for. You've got to be there, and you do this manually. You can close a trade whether it's in profit or whether it's in loss. You're not restricted to only closing a losing trade or only closing a winning trade. To get out of a trade at a specific price, no matter if you are there watching the trade or if you're away, these other kinds of orders you can use. You use a stop loss order. You set the maximum loss a trade can have before you close the trade at a loss. Then there's the take profit order, and you can set the profit level, the profit that you want to earn before closing the trade. Because as you know, the market can move up and down and up and down, and take profit order will prevent you from getting into a nice trade and then having it reverse. It'll take your profit at a certain level, get you out of the trade in profit, and then from there the market can do whatever it wants. The stop loss order. We'll take a closer look at this. It's an order that will always be behind the current market. If you're buying, your stop loss will be under the current price. If you're selling and the market's going down for you to make a profit, if you're selling, your stop loss will be above the current price. So it will have to change direction and go the wrong way in order to get tagged. A stop loss order is used in two different ways. You've got the initial stop, and then there's a trailing stop. The initial stop loss is the stop loss that you place when you get into a trade. The initial stop loss is going to limit how much that you can lose on the trade. If you want to only lose 10 pips, let's say you're in the trade and you say your maximum amount that you want to lose on that trade, if it goes horribly wrong, will be 10 pips, then that initial stop is placed 10 pips away, or 25 pips, or whatever you want that to be. The trailing stop moves towards the market price. So as the market is moving in your direction, you kind of want to follow that current price with the stop loss. So you can actually move that stop loss to your entry level if the price is moved ahead far enough, so that when the price finally does turn around, you can get stopped out at break even, they call it. That's when you get stopped out at zero, so you don't lose anything. As price moves even further and further into profit, you can start moving that stop loss past your entry level and start locking in some of that profit. So if the market does eventually turn around and go the wrong way, it'll stop you out, but it will stop you out in profit. The take profit order will be placed in front or ahead of the current market. If you're in a buy trade, your take profit level will be higher than the current price. It will be up on top. If you're in a sell trade and you want the market to go down, the take profit order will be placed below the current market price. This take profit order, will close your trade once your target has been reached, once you get to that price level. And now we're going to take a look at a couple of different trades with entry, stop loss, take profit. See, the black line, the black dashed line will be your entry level. Your stop loss, because you're in a buy trade in this example, you want the market to climb. So your stop loss is going to be underneath. It's going to be first your initial stop loss. That's where you put the stop loss for your maximum allowable loss. And then the green is your take profit. That's how much you want to get out of it. So as the price starts to move up and up and up, you can start moving that stop loss, that initial red line, up closer and closer and closer to the black line. And once you can meet the black line, then you're at break even. And then as the blue arrow gets closer and closer to the green line, to your take profit level, you can start moving the stop loss up higher than that black line, that entry level. So if the market does get close to your take profit level, but then change its mind and go the wrong way, you can get stopped out and still keep some of the profit. Otherwise, the market will just keep rising and tag your take profit level and get you out of the trade with the amount of money that you wanted to win on that particular trade. And lastly, we've got an example of a sell trade. It's the exact same thing. Everything is just reversed. We want the market to go down, and the black dashed line is where we've entered, and we're in profit currently because the price is falling. The stop loss is above where we are currently. It's always behind the market price, and if you're selling, the stop loss will be above it. The take profit is down below. Market is dropping in a sell trade. It wants to hit the take profit for you to make money. And again, the initial stop loss is where you place the stop loss first. And then as the price moves towards your take profit, you can move that stop loss into profit and closer and closer. And if the market gets close to your take profit, but then changes its mind, it goes the opposite way, you can actually get out at a stop loss, will get hit, but you'll still have made a little bit of money because you've locked it in. That's the trailing stop. Or you hit the take profit, gets you out of the trade at the price you wanted, and it's a good trade. Well, thank you for watching the different kinds of orders video. It was fun for me. You take care, and I'll see you in another video.